It does seem like we're going to shine more of a light in the months to come on the deficit and the debt situation. What's the investor implication, do you think?
Well, I think the downgrade by Fitch really shouldn't have caught everybody by surprise. They were on negative watch for quite some time, and it just followed suit with the downgrade by S&P some 11 years ago. But it is now a split rating. We have to remember that Moody's still has the U.S. at a AAA rating and a stable rating as well. So I don't think the implications on debt markets or debt servicing are that great right now. But psychologically, it does make everyone start to question how strong is this economy right now. And if the Fed continues to raise interest rates in the face of it, not only is it going to make it cost more for the U.S. government to service their debt, but what about the U.S. consumer that put $180 billion on their credit cards last year, that are now facing credit card interest rates of 21%? Each time they raise by another 25 basis points, that makes the cost of servicing that debt only go higher. And if the consumer now has to pay off credit card debt as opposed to spend, the economy is going to slow down further. And perhaps now we're starting to talk about recession again.
Well, I don't mean to strain the parallel here, but there is something that reminds me this year of 1987. Mm-hmm. I am not suggesting that there's going to be a crash in the market, but you had a market that was rising.
Yes.
And you had a world where interest rates were rising.
Yes.
And eventually the two collided.
Yes.
And the market didn't like it.
Yes.
What do you think as we head to the fourth quarter?
There is a day of reckoning coming for the U.S. economy. Even by the Fed's own projections, they believe GDP growth for this year is going to come back to 1%. They're also forecasting the Fed funds target rate next year to come down to 4.6%. And in the following year, Tyler, come down to 3.4%. So if I'm doing the math correctly, they're coming down over 200 basis points in the next 2 years. The Fed doesn't cut rates if the economy is doing well. They know what's coming, and this is an intended consequence of all their rate hikes. But if we as investors know that rates are going to be lower over the next 2 years, that yields are going to be lower over the next 2 years, and then inflation is going to come down, all of a sudden now you can start seeing very attractive investment opportunities in both stocks and bonds with that 2-year outlook. You just have to get through this difficult next 6 months. So a couple areas that we like right now on the stock side of the equation are in the sectors of technology and also the sector of healthcare. Healthcare you can play through different ways. Large cap pharmaceutical companies such as Merck pays an attractive dividend yield of 2.7%, have been growing their dividends over the last 5 years at nearly 10%. If you want a smaller cap pay, look at some of the smaller cap biotech names and the pickup in M&A activity that's taken place there. And then when I look at technology, of course, the AI side, you have the Microsofts of the world, you have the Alphabets of the world. But how about analog devices? They've had a 5-year dividend growth rate of 11%, have a dividend yield of around 2%, and they're in that all-important chip space, focusing primarily on industrial chip manufacturing, industrials, and the automotive services area. So those are different ways to play this slowing economy, lower rates, and the opportunity for growth over the next 2 years.
It's a weird situation, though, because now you have people worried, okay, well, what if we don't have lower rates? You know, what if, so maybe we can show the dollar here as well. The trading action the past couple of days, you have dollar under pressure, bond yields moving up. This feeling of almost, can we really absorb the issuance required to kind of fund the deficit and at what price? The fact that we've been funding it with T-bills at 5.5%, of course, Warren Buffett's happy to buy them. Who wouldn't buy 5.5%, right? It's a gift, but then the flip side of that is what it's doing to the deficit. So, I guess the real question here is, can we be so sure that we can go back to kind of the old normal of lower rates and that happy environment for tech stocks and all the rest of it, instead of something a little bit more chronic?
If we're patient, we can. But I think this should also remind investors about the benefits of diversifying your portfolio geographically. If, in fact, the dollar is under pressure, if it continues to weaken, if we cut rates and that brings down the value even further of the U.S. dollar, well, then there's opportunities abound internationally in both developed markets and emerging markets. So maybe now is the time when you start diversifying your portfolio into sectors such as technology and healthcare, into different market caps, such as smaller cap, which is lagging large cap right now pretty significantly, and also go overseas.
I mean, and I guess to put it a different way, it is a little weird because you have two possibilities when something like the Fitch downgrade happens. You can either have a flight to safety trade globally where people go, oh, geez, and they buy treasuries and they buy and they bid up the dollar. Or you can have the opposite. And it is worth noting that we're seeing the opposite lately. The 30 years moving up. Obviously, Bill Ackman says he's shorting it, trying to market time. These things are not going to go there. But the reaction this week has been one that tells you Not that we're benefiting from a flight to safety trade globally, but it seems to be the opposite.
Yeah, and I think if you look over the next 2 years, again, if I can continue with this 2-year outlook, you look at the 30-year and the 10-year Treasury, they're coming in by about anywhere between 25 and 50 basis points. That's it over the next 2 years. The shorter end of the curve, Fed funds, are going to come down by over 200 basis points.